Yes, so it was interesting. We've had the Bank of England numbers out today, which on the surface look pretty healthy. So purchase numbers are up from the numbers, but I think it's worth commenting on some of the underlying data we're seeing. So on the surface, it looks pretty healthy, but if you look at the purchase numbers, they reflect activity that was actually going on in the market from May and June. So anybody buying a house obviously makes a decision to purchase. And as you probably know, a completion chain takes anything from sort of 3, 4, 5 months to go through. So the Bank of England completion numbers reflect market activity from May, June this year. What we're seeing, if you look at mortgage illustrations, so anybody buying a house now, the numbers are dropping off quite dramatically. So if you compare mortgage illustration numbers, so anybody going to sort of buy a house now has to get a mortgage illustration from a mortgage broker. Those numbers are down about 20% from this time last year. And obviously the market in 2024 was significantly slower than 2025. So we're seeing market activity drop off quite significantly. At the moment, it's difficult to be precise about why it's falling off. We're speculating that there's 3 reasons why the number of purchases is dropping, particularly in the last sort of 3 months, the last quarter really. There was a big sort of jump in purchase activity in Q1 this year. That was partly because of stamp duty ending, sort of the first time buyer sort of change on stamp duty finished. So there was a forward sort of momentum on people sort of maybe bringing their activity forward. So that was partly maybe why sort of purchase numbers starting to drop off a bit in the last sort of 2 or 3 months. But a lot of it we think is around nervousness around what's coming up in the budget. There's rumours around national insurance being put on profits for landlords. So that's putting off buy-to-let investors. But there's also lots of rumours around changes to stamp duty, whether there's a mansion tax coming in. So, for example, capital gains tax being put on properties worth over 1.5 million, or even changes to stamp duty above properties for 500,000. Now, if we're in London, 500,000 is probably, most of the properties in London. So those sort of rumours are not really helping buyers buy with confidence. And we think those sort of things are influencing buyers' decision making, and buyers maybe holding off till they have some sort of certainty as to, really what's happening. So I think any market will probably adapt through time. So I think people need a house. Let's be honest. So long term, every kind of analysis about cost shows that owning something over the longer term is better than renting, unless your circumstances dictate that you need to move on a frequent basis. So owning over the long term makes much better financial sense than renting, and buyers will adapt. So I think that makes sense. I think they're talking probably about the mansion tax or capital gains applying from what we've heard above 1.5 million. I think if you put an arbitrary ceiling at a price, so for example, 1.5 million is what we're hearing on that level, you affect not only properties above 1.5 million, because, frankly, if anybody owns a property above 1.5 million and, they know if they sell it, they're going to get hit with, a big capital charge, they're simply not going to sell. And what that does, that impacts the market all below. It affects the property chain. So, those sort of properties don't get sold. People who want to move up market and buy their next house can't do it. It affects the chain below. So anybody who buys a house knows that, often they're in a housing chain, that they're buying a flat, person above them is buying a semi-detached, person above them is buying a detached. And it will have an impact right across the whole housing market. So any government thinking about introducing arbitrary numbers on, whether it's 1.5 million, 500,000, has to think about the impact, not just at that level, about how it sort of ripples across the whole housing market. One of the challenges of the UK housing market is a lot of people bought sort of nice big, 4 or 5 bedroom detached houses when the children were young. And, the children move home and they become empty nesters, and they get into their 60s and 70s or even their 80s, and they're left rattling around. And one of the things that I think governments potentially need to look at some point is some sort of incentive for them to downsize. And if there was a mansion tax, for want of a better phrase, that's a big disincentive for these people to move and downsize. You should be kind of encouraging those people to downsize to sort of, a property that's probably more appropriate for their age and suitable for them, and, free those properties up for, people who've got younger children and the like. So, like I say, a mansion tax would be a disincentive for those people to sell.
We're living in a time of what feels like pretty significant social change, and it makes us question things that we've even taken for granted for decades. And one of those at the moment that people are wondering about is actually money. Is the money in your bank account safe? Should you be investing elsewhere? Are we looking at a potential global crash? What will it mean for your savings? Is there a way that you could be using your money that might be outside of government control even? Well, Tally Money is potentially one solution. So I'm delighted to say that I'm joined today by the CEO and founder of Tally Money, Cameron Parry. What is Tally Money?
Well, at Tally Money, you basically get gold you can spend. So we give people an individual account in their name, everyday account. They get a sort code, an account number. They use that account just like they would pounds from their bank, but it's milligrams of gold that we brand as Tally.
Okay. Why would you do that, though? What is the benefit to the customer instead of just having a normal pound sterling account?
Gold's performance against the pound is above 11% per annum over the last 25 years on average. But we still need money in our daily lives, and we have savings. We know that it's good common sense and prudent to save up for things, not just living credit. You know, whether it's a holiday or a rainy day, your retirement planning, you need to have money in your life, basically, that you can rely on, that's dependable, that nobody meddles with, that nobody can weaponize against you, which is another element of government control when it's the government currency, which we could talk about another time. And it should be pretty simple and straightforward, and that's what we deliver at Tally. And really, we just want people to feel safe and happy with their money. There was a time when the bigger your bank balance, the more confident you felt. Now it's like, I need to do something with it. I can't leave it there. In Tally, you can.
Okay, brilliant. Cameron Parry from Tally Money. Thank you so much.
Thank you, Bev.
On remortgages, I don't. Remortgages tend to be a circumstance, so you need to remortgage. So when your fixed rate's coming up, generally, you know, you're looking or talking to your mortgage broker or talking to your lender. Your fixed rate matures in, say, 2 or 3 months, and you're either going on to the lender's SVR, which is often quite punitive and quite a lot higher than the fixed rate you're on, or you switch to a new rate. So customers generally just have to switch to wherever they are. So remortgages are an outcome, if that makes sense. They're not really a choice from a customer. They have to remortgage. So, remortgage numbers are what they are more than anything. The biggest mistake is leaving it too late. So normally when you remortgage, lenders will contact you, and your broker, if you've got a good broker, your broker should contact you about 3 months before your mortgage is due to come up or the fixed rate is due to mature. What should happen is you'll go to your lender or you'll speak to your broker. Your broker will say either go with the product the lender's recommending, or the broker will find you another product. Once you've switched, you've got 3 months to either accept that product. So you'll get a new mortgage offer from either your existing lender or a new lender. If a better product comes out in that 3-month period, you can drop the rate. So it's a one-way option. So for example, if the lender offers you a rate of say 3.8%, and in that intervening period, a better rate comes out, you can go to the better rate. What you shouldn't do is leave it too late. So for example, you get within sort of a week or two of your fixed rate maturing, and you suddenly decide, or haven't done anything about it, because you might find yourself on standard variable rate for a short period of time, paying a higher interest rate before you can switch off and do something else. So my advice is don't leave it too long. So at the moment, inflation is proving to be very stubborn. CPI is around 3.8%, and it's printed at 3.8% for the last 3 months. The good news, if there is any good news, is the Bank of England was expecting inflation for September to come in at over 4%, and it actually was lower than expected. And that's probably about the first time it's actually come in lower than expected for quite some time. The other things they're looking at is wage inflation. wage inflation is cooling quite significantly. So wage inflation was around 6% at the start of the year. It's now down around 4.7%. And obviously wage inflation feeds into general inflation. So that's coming down quite significantly. So that's good news in terms of bringing interest rates under control. The other thing the Bank of England is looking at quite significantly is job growth. If you go back to 2022, there were around 1.2 million vacancies. If you look now, we're down to about 630,000, and the number of job vacancies has fallen for 39 months in a row. So the UK economy is cooling. So the Bank of England is looking to potentially stimulate growth, given that also inflation appears to be gradually coming under control. Now, having said all of that, inflation is still, as you pointed out, above the 2% target. So Bank of England meets shortly in November. I don't think we'll get a rate cut in November. Might get one in December, but it really depends on what Rachel Reeves does in the budget. So I think we're probably 50-50 for December. I think if we don't get one in December, we will almost certainly get one in February. And then I think we'll probably, and this is a little bit of crystal ball gazing, get one in the spring. So by, I think, early summer, we could be down to 3.5% in terms of bank base rate. So mortgage rates are probably near where they're going to be because much of the anticipation around where bank base rate is likely to fall is already priced into mortgage rates. So lenders price fixed rates using a thing called swaps from the money markets, and it already anticipates where it thinks bank base is going to fall. So the money markets are sort of betting at the moment that bank base ends up around 3.25%, probably around middle, late summer next year. That's kind of the anticipation. Now, it's really a little bit of unknown as and when the timing occurs, because obviously inflation, as I said, is a little bit stubborn. The UK economy is not performing perhaps as well as it could do. So timing's a little bit uncertain. Whether it ends up at 3.5, 3.25, it's a little bit difficult to see. But much of the sort of anticipation of where bank base rate comes in is priced into mortgages at the moment. So consumers should not expect that if bank base rate gets cut down to 3.5, maybe 3.25, that mortgage rates are going to fall much further. It's very unlikely. Yes, so lenders are, and I know, customers will probably get the world's smallest violin out when we talk about lenders and mortgage rates, because, I know lenders don't necessarily attract the most sympathy, but it is very, very cutthroat with mortgage pricing out there. Lenders are lending with very, very small margins. It is extremely competitive between mortgage lenders out there. So, lenders are, trying as much as possible to give consumers very, very good deals. So, as and when consumers' mortgage deals come up, speak to a very good broker or your broker, have a shop around. There are some very, very good, fixed rate options out there at the moment. House prices are very interesting. If we just look at the big picture, house prices for the year have sort of bumped along the bottom a bit. They've done around 1.3%, but it's really kind of micro markets within regions. Houses have done reasonably well this year as a whole, but flats have not done particularly well. And London versus the north and the south has not done particularly well either. And it really comes down to affordability. So more affordable regions, it's like the northeast, the northwest, house prices have grown in sort of, medium single digits, like 3, 4, 5%. Flats have continued to struggle. Flats, it could be down to a number of things why flats have not been doing particularly well, particularly in London. There has been a bit of an exodus of landlords from the market, given, buy to let. So there's been more flats coming onto the market. So there's been a supply and demand. There's a continuing issue around sorting leasehold out, which has put maybe some buyers off flats. And there's still potentially, and this is, me just kind of thinking out loud a little bit, an issue around people post-COVID wanting some outside space a little bit. So there's this whole kind of issue that people are sort of desiring a house a little bit more over flats. So houses have done a little bit better. The north's done a little bit better. London and southeast has done a little bit worse. And that's kind of it. And we suspect that may continue into 2026. At the moment, houses, they're a long-term purchase. So if you're looking to buy a house, the market goes through, ups and downs, cycles. Most people stay in the house for long term. So people buy a house for 5, 10, 15 years. Don't be put off by, what may or may not be happening to stamp duty. If it's a house you want and it's a house you want to live in long term, that's fine. As long as you're not looking to speculate from a house and you're looking to sort of try and make a short-term financial gain, don't be put off by, what may or not be happening. House, is a good investment long term. So, just go for it. What's happened is as the mortgage rates have come down and as bank base rate has come down, the way lenders calculate how much you can borrow has changed quite dramatically in the last year. So if you went to a lender a year ago and said, how much can I borrow? They'd have lent you X amount. If you came to them this time this year, they'd probably lend you another 20%.
Okay.
Which is quite dramatic. So, this time last year, you could have gone and said they'd lend you 300. Go back a year later, they might lend you 360,000. So although, you might pay a bit more stamp duty, part of the benefit for first-time buyers in the last 12 months is lenders will lend you a lot more.
Yeah, I've seen that. I think Nationwide had a
times six.
Yeah.
So the regulator and the Treasury have signalled that they're much more willing and able to help first-time buyers. So that's a big point, maybe I don't know if you want to get that across. So if you are a first-time buyer, okay, you might pay a bit more. You're paying a bit more stamp duty from April, but actually you can actually get the loan you want. Might cost you another, 3 or 4 grand in stamp duty, but actually before you might not be able to enter the market because you couldn't get the loan you wanted. Now you can get the loan. Biggest challenges facing first-time buyers are the ones that have always been out there, which is affordability, finding the deposit, basically. The good news for first-time buyers is in the last 12 months in particular, affordability, particularly from lenders, has changed dramatically. So in the last 12 months, because interest rates have dropped and because the government and the regulator, the FCA, have relaxed affordability constraints, lenders are now lending about 20% more than they were around 12 months ago. So if anybody has been looking at housing and thinking about trying to get on the housing ladder, it's worth approaching a broker, speaking to a broker or going direct to a lender, just having a chat about how much you can borrow. The rules have changed. Lenders are now doing sort of 5.5, potentially even up to 6 times income. So, it's much easier than it was, a year or two ago to potentially get on the housing ladder. There are lots of options out there to help first-time buyers, those with very low deposits as well. So, lenders are being, particularly flexible about trying to find solutions to help people get on the housing ladder. So it is challenging. Lenders recognize that finding a deposit, trying to get into a market where, properties can be sort of on average 8 times income in certain sectors of the market. But, the solutions are out there if you work with brokers and try and find something.